Okay, so chapter 12, again, I think is one of the harder chapters. I think chapter 13 is probably the hardest chapter. Um, but there's some challenging stuff in here, and I think some important concepts. Um, so what are we going to be talking about? Really, this chapter is, uh, I think this is one new topic, mortgages. Okay, how to do like calculate uh, schedules, like loan payment schedules, bond payment schedules, like how to have like basically a tabulation of all the payments. So a mortgage we're going to see is a little different, how that's done. We've done some of these payment schedules for like loans payable or loans receivable. So I think we'll be kind of okay with the simple version of this because we've seen it already. But the mortgages, that's going to be a little added thing. Um, the big topic of this chapter is bonds. Okay, so how to account for bonds. So we'll talk about what those are and the different accounting topics related to it. This one is, kind of a related topic for bond payable. So we'll talk about how to account for the interest expense because it's not as straightforward as a loan, and we'll see why that is later in the chapter. Um, and just like we had with plant assets, there's birth, life, and death. Bonds also kind of have a death where they're retired, they're paid off. So how to journalize that. Um, we'll look at, this is kind of related to this. These two are kind of related to each other. What the heck? These two are related to each other. So we'll talk about how companies will report. Sorry, I was about to sneeze. How they report liabilities on the balance sheet. Um, this ratio, the debt to equity ratio, it's very similar to the debt ratio, which I think we did in chapter 2, because as we know, assets equals liability plus equity. So the debt ratio, if you remember back, was liabilities over assets. Okay. So because this liability is equal to something, it's equal to assets minus equity, you can rearrange this ratio into different ways using substituting things. Okay. So the debt to equity ratio, as the name implies, is the ratio between these two, but it's related to the debt to this debt ratio because liabilities are related to liability. Sorry, assets is equal to liabilities plus equity. So you can kind of use the debt ratio and the debt to equity ratio, and you can solve one for another. But we'll kind of see what this ratio is, and then really I think maybe one of the most important. Oh shoot! Hold on. Let me do something here. Sorry. Okay. Okay. Sorry. Um, maybe one of the most important concepts if you want to be in business, finance, etc., is time value of money. Okay. So it's when you're working with bonds, it's a very relevant topic. So we're going to kind of introduce it here. But in general, I'll show you how it's applied to many, many different types of financial analysis. Um, it's maybe the most important. If you're gonna be like a finance person, you want to get tattoos. Number one tattoo would be assets equals liabilities plus equity. You get that on your like left shoulder, and then the other one would be future value equals present value times one plus r to the t power r. Okay, so this is the time value of money equation. Okay, so these are probably the two most important frameworks in finance, investing, accounting. Okay, so we'll talk about what this one is. You guys are now familiar with this one. Okay, um, so review. Uh, what is the difference between long-term and short-term liabilities? Does anyone want to share what the difference is? Yeah, Mohammed. Yeah. Exactly. So 1 year is usually the cutoff. So any liability due in a year or less is short term. Over a year is long term. Okay, so we've mentioned some of these. So what are some common types of long-term liabilities? I've just mentioned them as I've talked about this chapter. Yeah, Tyler. Mortgage payable. Okay. What else? Anyone else? Because typically, we think of residential mortgages. What's the typical length of a residential mortgage? Like the mortgage your parents may have on their house? 3 years? 30 years. Yeah. 30 years. What else? What's like this? This is the most common. What's the second most common? 15. Yeah. These are probably the two most common insurance products. Okay. Sorry, not insurance, mortgage products. So most people get a 30-year mortgage. Why? Why would they do that? What's the advantage of a 30-year mortgage? You're paying more interest, right? Because you have 15 extra years that the loan is outstanding. But what is the benefit? Yeah, Margaret. Exactly. Okay. So if you're borrowing $500,000, let's say, just forget about interest. Okay. If you're splitting this up over 30 years, the payback amount you pay per month is less because it's a much longer period of time. You're splitting over more payments. Okay. So people say, oh, the bank's 30-year mortgage, you pay if I think if you do the math, depending on the interest rate, you'll borrow 500,000 up front, but you'll pay like another 500,000 in interest. So you end up paying like $1 million, right? But people don't understand that you have 30 years to do that, right? And so if you got a 15-year mortgage, you can pay it off sooner. You have the opportunity to pay much less interest. But if you're choosing a 30-year mortgage, you're making an intentional decision to make a smaller payment. The payment difference between these two, you can invest, right? So though you're paying more interest, that extra cash flow, let's say the payment for this was 1,500 and this was 2,500 per month. And these are hypothetical numbers. This extra $1,000 you could invest in something, right? And over 30 years, you'll probably end up with more than you paid in extra interest if you invested it well. So I think you can't really take the headline of like, oh, the mortgage banks are stealing from people, etc. No, you are making an intentional decision. You're minimizing your monthly payment by taking such a long-term mortgage, and you can do other things now that your mortgage payment is smaller. Okay, so don't be, again, I think we get a lot of rage bait in the media about like our financial lives, but you got to be a little more savvy. Hopefully, little tidbits you're taking away from this class. Okay, even though it's not you should take my personal finance class next semester. I teach a class just on personal finance stuff. So that's also, you guys will be set up pretty good to take it. It's a much easier class than this, but I think far more practical. I think it will set you up to like do well in your financial lives if you take that class. Okay. Um, okay. So what else? Okay. So we had mortgage payable. What else? What's another type of long-term liability? Yeah. Yeah, but let's talk about from a company's perspective. Yeah, but you're right. A company may have a car loan. They bought vehicles using financing, so it's possible. Yeah. Anyone else? Yeah, yeah, Tyler. Notes payable. Okay. What are we gonna say, Mohammed? Notes payable. Okay. Yeah. The other one, the big one, is bonds payable. Okay. So these are kind of the main ones. There are some tax liabilities that are longer term. Um, maybe towards the end of the class, we can maybe look at some companies and see what else they have. But yeah, these are kind of the major ones. And this is going to be like notes payable, same thing as loans payable, some kind of bank financing. Okay, you're borrowing from some financial institution. Okay, good. So um, when we talk about long-term notes, when we talk about bonds, we have what we call a schedule, right? We borrow a 30-year mortgage. We can plot out the next 30 years of payments because these types of financial products like loans, bonds, mortgages, they are fixed. There's a fixed payment schedule. Okay, so we can ahead of time make a table for every payment that we're going to make for the next 30 years. Okay, so I'm going to show you like Contra Costa County Community College. They have issued a bond. So I'll show you guys the payment schedule for that. It's not quite like a standard one where there's either payments every month that's the same amount like a mortgage, nor is it one that waits to pay all the principal at the end. Okay, so we'll see. But the fact is, when they issue that bond, they set that schedule ahead of time. They told the investors exactly when the payments are expected to come. Okay, so I'll show you that in a second. But the point is that there is some schedule. You're gonna plan out the principal and the interest for the entire life of the bond. Now, it's not always fully possible because sometimes the interest rate is floating, meaning it changes, it resets, but at least the principal payments you can plot out ahead of time. Okay. Um, so again, what is the schedule going to have? It's going to have the total amount of each payment. It's going to split principal and interest because remember, if you pay, you know, $2,000 a month for your mortgage, maybe, especially at the beginning, we'll see this in a second, more of it is interest. Maybe $1,800 is going to be interest and $200 is principal. So this is principal and interest. But the payment schedule will break that out. You'll be able to see oftentimes what the split is. And then you'll have what is the outstanding balance, right? Um, for a mortgage, you're starting off with say 500,000. It gets reduced to every payment you make, right? So the schedule will have after each payment what the balance is, and you can see it kind of declining if you have principal payments like regularly. Okay, so again, we'll see that. And you'll see the dates, okay? The dates of the payments will also be listed out. Okay, so an example, if we have a $20,000 note payable, it's due in 4 annual payments of 5,000 plus 6% interest, okay? So we're going to pay off this principal in equal increments, and we're also going to pay interest. So you can see here in this table, we have beginning balance, how much is principal, how much is interest, how much the total payment is, and after that payment, what is the ending balance? So if we took out the loan in 18, the first payment date is here, 1 year later. So the principal balance is $20,000 to begin with. We're now making a payment at the end of the year. And as we said, we're going to split the principal into 4 equal payments of 5,000. You can see that each year here. It's split up evenly. You can see that the interest in the first year is 1,200 and it's different in the next year. Why is that? Why did the interest amount go down from the first year to the second year? Yeah, because the principal decrease, exactly, right? And you're only paying interest on the principal balance, right? So let's just explain this a little bit better. So first, you're going to pay, this is 6% times 20,000 times 20K. Because your principal for the year from December 2018 to December 2019 was this much. So for 1 year, the principal outstanding was 20,000. So you're going to pay the 6% interest on that full amount of principal. So the total payment that you pay to the lender is 6,200. But now the balance is less. It's only 15,000 because you paid 5,000 of principal. So this 900 is basically 15,000 times 6%. And then this is 10,000 times 6%. And this is 5,000 times 6%. Because again, every payment, not only are you paying the interest, you're also paying principal, 5,000. Okay, does that make sense? So really, if you wanted to like um, generalize this, this is equal to whatever the beginning balance was times the interest rate. So 15,000 times 6% is this, 10,000 times 6% is this, 5,000 times 6% is this. Make sense? So you see how maybe you're gonna have some Excel functions, formulas that are going to result from this? Yeah? Okay, good. Okay, so um, okay, so yeah, I mean, maybe you're already seeing like to make a payment table in Excel, like this is equal to this is equal to this. So you can have cell references. This one is equal to this plus this. So you can see how, we're going to do it together, but, maybe I'm hoping that you're starting to start thinking in Excel a little bit, okay? Where you see some problem and you're like, okay, I know how to set this up in Excel. Okay, we'll do it together, but that's one skill I think is kind of useful. Okay, so uh, this schedule is useful for making our journal entries. Okay, so for example, the journal entry when we first get the loan, this is on this date when we first take out the loan. Cash, we're receiving 20,000, and it's for a liability 20,000. Okay, so this should be pretty easy. Now we can use this table to figure out what the journal entry is for this date because we kind of have all the information. Okay, so sorry. Okay. Yeah. Okay. So for example, I think we're gonna do maybe this one. Okay. So on December 31st, 2021, we can use this table to figure out what the journal entry is. So if we look here, December 2021, we go up to the table, we see that the total payment amount is this. So what is this going to correspond to? How are we paying the bank? What do we give them? We're giving them interest, but like in what form? Like when you pay your credit card, what are you giving the bank? Cash, exactly. So we know that this amount of cash is going to come out. We also have the breakup here of what that cash consists of. Some of it is going to go to pay off the note payable. Some of it is going to be expense. Okay, so if we look, we see that again, cash 5,600, interest expense 600, right? Interest is always an expense for us, right? It's kind of the rent that we're paying for having that bank's money. So we got to pay rent for it, and we're also going to pay off some of the balance. So that's going to reduce notes payable because from here we have notes payable. It starts off at 20,000, right? Every payment we're basically going to be going like this: 5,000, 5,000, 5,000, 5,000. So the last payment will have a zero balance. So I think we're on this one. So this 5,000 is the debit that's going here. Make sense? Okay. Okay. Um, so now when we talk about mortgages, the payment schedule is more complicated, okay? Because every payment is going to have a different split between interest and principal, and the principal amount is going to change. In a mortgage, the payment stays the same. So we can see up here, you can see that since our interest amount is changing, right? We talked about these changing. This is fixed, but since the interest expense is changing, our payment every year is different, right? A mortgage is different. What it's doing is it's going to keep the payment amount the exact same every month and figure out, there's a pretty complex, it's not straightforward how to do this, but how to get one fixed payment amount that will get you to a zero balance at the end of the mortgage term. Okay, this is not a straightforward calculation. Okay, because basically your principal and interest amounts are going to vary every payment. Your payment stays the same, but the split between principal and interest is going to vary. And how to get that math to be such that your ending balance is exactly zero, it is not a trivial like it's not a trivial math problem. So there's luckily a function in Excel that'll show you that does it automatically. Okay. Um, but this is the big difference with the mortgage in that instead of fixing the principal payment or the interest payment, it's fixing the total payment and then backing into what that payment needs to be to get the balance to go to zero. And again, I'm saying this in words. I think it'll be easier when we do it in Excel. But um, the key thing to think about is in a non fully amortizing mortgage, you're going to have different payments. Okay, these are all different every year. With a mortgage, like how we're going to kind of do the calculation, like a fully amortizing mortgage that has fixed payments, these are all the same. Okay, the split between this and this will be different every payment. So again, we'll see this in a second. Okay, so a mortgage is really just a special type of loan. It is secured by some asset, usually real estate. Okay, so um, some loans, like a credit card, they're just giving you a loan based on your credit score and like kind of generally how much the bank thinks that you're gonna be trustworthy to give a loan. Okay, so uh, it's a little riskier because if you stop paying, the bank is they're kind of cooked. Like what can they really do? They can't force you to pay, right? You can declare bankruptcy and just like get rid of the loan. Okay, what the advantage of a mortgage is that if you stop paying, the bank has recourse to some asset. So auto loans, for example, they can repossess your car. A mortgage, they can repossess your house, right? So the ability for them to recover their money if you stop paying, it's more likely. And the benefit of that to you as the borrower is that the interest rate will be lower because the risk is lower. Okay, that's why credit card interest rates are so high. It's a form of unsecured lending, while a mortgage, like maybe you're paying 22% on your credit card, but your mortgage is like 6%, right? And it's because the riskiness of the mortgage is much lower because the bank has recourse to your house. Okay. You could potentially, if you have good credit, have like an Amex Black Card and there's no credit limit and you can borrow the money to buy a house with that, but you're going to pay 20% interest. So that's why no one does it. It's better to get a mortgage and you're giving up something because, the bank can take your house, but you're getting a much lower interest rate. Okay. So, um, again, mortgages for residential mortgages, meaning like for buying houses that people live in, it's usually 15 or 30 years. For commercial real estate, it can be shorter. It can be 3 years. It can be 5 years. It can be 7 years. Okay. Now, the problem with that is that you're not able to fully pay off the balance in 3 or 5 or 7 years. So the company will have to figure out a way to refinance, get a new loan, extend the loan, because they're not able to pay off all the principal in 3, 5, or 7 years. So it's riskier. Your residential mortgage over 30 years, once you make that last payment after 30 years, the balance on the mortgage is zero. Okay, so just it kind of slowly dies away on its own, and you don't have to worry about coming up with a big sum of money at the end. While commercial mortgages, you oftentimes do. Because again, it's all about managing the payment, right? If you had to pay off a commercial mortgage in 5 years, the monthly payment is going to be massive because you have to pay off not only the interest but the principal too. And you're splitting, if you have like a $1 million commercial mortgage, if you just, again, forget about interest. If you're just paying off the principal over 3 years versus 1 million over 30 years, it's a much smaller payment if you had this just for the principal. Okay. So oftentimes in real estate, there's not enough cash flow from the property to fully pay off this $1 million in 3 years. Okay, so that's why there's a balloon payment, and you have to find another lender or tell the bank, "Hey, give me 3 more years," and just keep going like that. Okay. Um, Amortization, this term refers to, in the context of a bond or like a loan, it's payment of principal in set payments. Okay, so it had a different context for like uh, amortizing like intangible assets, but in the context of bonds, loans, payables, It means just the payment of principal. Okay, any questions on this? This is just, I'm just trying to lay out some terminology and stuff. So some of it may be familiar because we all, mortgages are a big part of just people's financial lives. So hopefully you've heard a lot of this already. Okay. Um, okay, so let's look at this table. Okay, so I'm going to set up, or I have certain loan terms, okay, and I'm going to show you how you can set this schedule up yourself because you'll have to do this. We'll do a practice problem, but the homework has this a problem where you're gonna have to do this. So pay attention. So I have the loan amount here. I have the term of the loan here, and I can change this. These are all variables I can change. Okay. Well, let's just leave it at 30 years. Interest rate. These in yellow are formulas. So this formula is converting the yearly interest rate into a monthly by just dividing by 12. And this payment is a monthly payment. So you can see both of these are per month. So the function in Excel is PMT. Okay. So what are the inputs to PMT? Let's just start from the beginning here. Okay. So, oops. Okay, so first it's asking for the rate, and that means the interest rate. And the thing you have to remember about this PMT function is if you want a monthly payment, you have to give it a monthly interest rate. Okay. So that's why I have this 0.5. Because if I put 6%, it's going to assume 6% per month, which is like a really high interest rate. Okay, so make sure you're putting, if you want a monthly payment, make sure it's a monthly interest rate. If you wanted a yearly payment, you could put 6%, but then it's going to tell you the payment amount if you're paying once a year. Okay. Okay, so secondly, it says number of periods. So uh, if I put 30, then it's going to give me a yearly payment because it's 30 years, but it's going to assume a 0.5% interest rate. But what do I actually want? I want a monthly payment, right? So if it's 30 years and I'm paying monthly, how many payments am I going to make? What is the math? 30 times what? 30 times 12. It's 360. Okay. So I'm going to multiply this by 12 because again, I'm trying to get a monthly mortgage payment. The present value in the terminology of this function means the loan amount. How much am I borrowing up front? So it's going to be this 500,000. Okay, so now I can just close this. Also, the default is for a PMT to give you a negative number. So I put this negative here just so I get a positive number, just so you can see that the payment is just like the dollar amount. Okay, I don't want it to be a negative number. Okay, so let's see what happens when I change the term. So let's just directionally, if I change this to 15 years, is the payment going to go up or down? What do you think? Who votes up? Yeah, up because you're spreading out the payment of that 500,000 over fewer payments. Okay, so let's just verify that. So yeah, it went up significantly. Okay, so let's go back to 30. What if I change the interest rate? What if I make the interest rate 3%? Will the payment go up or down? Who votes up? Who votes down? Yeah, it's going to be down because you're still paying 500,000 in principal, but now the interest rate is lower, so the payment will be lower. So, okay, how about this? If I change it to 3%, do you think the payment will get cut in half? Okay, let's just copy and paste this number. So this is now a fixed value. Now we can compare. So we expect if it's a purely linear function that the payment should be $1,498. Okay, so let's see what happens. Okay, it didn't go down because the principal amount is still fixed. Okay, how about this? Let's go back to 6%. What if I change this to 60 years? Should it go down exactly by half? Is that now the principal amount is the same, interest rate is the same. I'm just doubling the number of payments. What do you think? Let's see. No, it didn't because you're basically going to end up paying a lot more interest, right? So these are non-linear functions. They don't behave perfectly in a linear manner, because as we're going to see, the payments are there's like a curve to the split between how interest and principal are divided up. Okay, so let's just change this back. Um, so in this first, so now I'm going to make a payment schedule for all 360 of these payments. Okay, so the starting principal is 500. The monthly payment I got from this PMT function. So I'm just cell referencing to that payment. This is going to be a fixed amount. Every single payment for all 360 of these, it's just going to be this. Oops, what the heck? Oh man, my Excel function is, my quick keys do not work in Google Sheets. Okay, so let's just do this, copy and paste. What the heck? Okay, okay, I think I know what the reason is. Okay, this. Now I should be able to do it. Okay, so every payment is going to be the same amount. Okay, this is again the key like feature of a mortgage, a fully amortizing mortgage. The payment amount is fixed. Now, the principal and the interest, how are they split? Okay, so you start with the interest when you're doing this tabulation for a mortgage. You basically uh, take whatever the starting principal is. In this case, it's 500,000 because this is the first payment, and you multiply it by the monthly interest rate. Okay, so this is the amount of interest. The remainder is principal, right? So you take the total amount of the payment minus how much is interest. That gives you the amount of principal. Does that make sense? So now we perfectly have split this $2,998 payment between principal and interest. Okay, the starting principal and okay, an ending principal. What is that? All it is a starting principal minus just the principal portion, not the total payment, right? The only amount that the mortgage balance is going down is by how much of the payment is principal. Okay? So now I can just use this formula. I just make my starting principal balance for my next payment is the ending principal balance from the last period. And I can kind of just apply these formulas down. Okay, so again, the interest is the starting principal balance times 0.5% or whatever the monthly interest rate is. The principal portion is just the total payment minus the interest portion. And then the ending balance is just equal to the starting principal minus the principal portion of this month's payment. Okay, so now all I have to do is just apply this all the way down. And you can see here exactly on the last payment date, I have this much payment, this much, the interest and the principal aligned such that exactly I get to a zero balance. Okay, so this is again this number 2998 is found by some function. It's not easy to it's not obvious how to get that number. It takes a kind of complicated solving of two linear equations. Okay, so it's not easy, but we have a built-in function that can do it. Okay, you can see here what is there to notice. Again, the monthly payment is fixed. You can see that the principal portion, every payment is going up. Okay, and you can see that as you go down, eventually in the last payment, it's like almost all of this payment is principal because your outstanding balance is not that much, right? So you have very little interest. Okay, so if you graph this out, let's see, you can see that it's not linear. Okay, it's a curve because um, the mathematics is just such that as your principal balance goes down, Um, yeah, I don't. I mean, well, a good way to word this, I got to think about. But you can just see that the amount doesn't just go up in a linear fashion. The rate increases of how much portion is principal versus interest over time. Okay, so this is why, just the functional kind of thing. When you first get a mortgage, the first like 5 years is mostly interest. So people think, oh, like I'm just throwing away my money when I rent. Well, you're kind of throwing away if you only own a house for like 5 or 7 years because you're paying mostly interest. Okay, it only accelerates where most of your payment is principal towards the end of the loan. Okay. Um, okay. So is everyone good on how to calculate this table? You're gonna have to do it now. Okay, we're gonna practice doing this. So if you have anything that you missed or you want me to show you the formula, ask now. Yeah, Scott. For which part? Okay. That's the important one, I would say. Okay. Yeah. And does someone have a specific question? Because I think you'll see where your holes are once you start trying to do it yourself. But does anyone want to, before we start trying to do this, want to ask anything? What, Scott, it sounds like maybe you got to start trying to do it and then you can see. I can come help you. Okay. Um, so, uh, okay, so actually, let's just do this. Just to show you how to use this for a journal entry. Okay. So, look, on July 1st, 2026, the company makes a mortgage payment. The total payment, again, we know where this number is coming from, right? We have our PMT function. Um, and we can look, and I think maybe the dates, no, 2488. I don't know, one of these dates. I don't know where I got these numbers from, but okay, let's just alter it a little bit. I'm gonna alter let's say we're making this journal entry for this payment. Okay. So the split is 2490 to interest and 508 to principal. Okay, so this table, instead of like months, we'll have dates here, and then when you actually do it, we just don't know what the start date is. But basically, each of these are 1 month apart from each other. So let's say we're doing the journal entry for the fifth month of payment. We know that this is the total payment, and the splits are 508 and 2490. So what I would do is the total amount that the bank expects, cash, 2998, and of that, 508 was principal, and what was the other amount? 2490 is interest. So I just got the numbers directly from the table from that schedule. Okay. Your only knowledge is to know that you're paying cash, right? That's the total amount of the payment that you're sending to the bank. 508 is going to go towards paying down the mortgage payable. And this is going to be interest expense. So as long as you understand kind of the accounts involved, the numbers are coming from the schedule. Okay. Make sense? Okay. Okay. So let's do this practice problem 12-39B. It's in the in-class Excel sheet. Um, it's the second tab, and it's giving you some information on just a regular note, and there's also a mortgage. Okay, so you'll get practice with doing the schedule for both of these types. The mortgage is the one, of course, that will take, you'll have to figure out how to do the schedule. The schedule for this simple loan is quite easy. Okay, because it's like, regular payments, and the payment amount changes because the principal balance changes, like the first example we did. With the mortgage, you're gonna have to do what I just did and figure out that payment, the payment amount using the PMT function, and then how to make that schedule. Okay, so why don't you try working on this and then we'll do it together. Okay, so uh, the beginning balance is 100,000. We have 5 equal payments of 20,000 to sum to 100,000. The interest is based on how much outstanding principal there is. In this case, since we've not made a payment yet, it's going to be based on the full 100,000. And the total amount of payments we're making to the bank is principal plus interest, so total of 35,000. So when I calculate the ending balance, we're not subtracting the total payment because the bank is getting some money of the payment is to pay down the balance. Some of it is their profit, how much they're earning from making the loan, which is the interest. So the only thing that we're going to subtract from the balance is just how much of that $35,000 payment is principal. And we know that it's 20,000 based on this table. Okay. So now the beginning balance for the second period is the ending balance from the first period. And we can just kind of use the same interest calculation. You can see here the next payment is a little less because we're paying a little less interest. Or we're paying a little less interest because the principal balance is less than the first payment. Okay, so now we can just simply use these formulas. I'm just going to do Control D, and you can see that it automatically populates this. So the key thing to remember for this first loan is that the payment amounts are changing. The total payment changes because the principal balance is changing. Okay? Okay, so now the first journal entry is asking us to, okay, so let's just do this Barrows Bank journal entries. Okay, so on March 1st, we take out the loan. We're going to get cash. We're going to have a note payable. Thank you. Okay, so hopefully you all got that. Again, let's just do the Barrow Bank, this accrual of interest. Okay, so we know this schedule has given us how much interest we're paying for the full year whenever we make that payment on March 1st of the next year. But this is a adjusting entry. We want to see how much interest is for this current year. And so it's on March 1st that it started. March, April, May, June, July, August, September, October, November, December. It's 10 months of interest. Okay. So I'm going to basically accrue, uh, this is again, is the full year is 15,000. So if I wanted to just accrue 10 months of that, what I would do is I would have interest expense, debit, interest. What? What should I do here? Interest payable. Good. And you can just do 15,000 times 10 divided by 12. Okay, so hopefully you all got that. The one for the other loan is pretty easy, or it's easier because it's just exactly 1 month. It's December 1st through the end of the month. So you can just use whatever interest you had on your table. Okay? All right, so why don't you guys continue working? Um, let's just give this another 5 minutes because we got to move on. Okay, so there are 2 challenging journal entries still left. I think this payment uh, for this loan that we just did, you have to, we've seen it before. Hopefully you'll remember how to do it. And obviously these mortgage payments. So just take a couple more minutes, think about how you're going to do it, and we'll do it together. Okay, so um, let's just do the last entry for this Barrow Bank, and then we'll switch to the mortgage. Okay, so now we're going to pay off this Barrow Bank. So really, the numbers I'm going to need are in this first payment, right? I'm going to be paying a total of 35,000. That's how much the schedule is saying I'm going to make in this first payment. So, and I don't know, this is 2026. So let's say this is 3/1/2027. 1 year later. So I know that the amount of cash going out is 35,000. Everyone agree with that? Everyone good with that? Yeah? Okay. Um, Now we did this. You can't forget about this accrual, okay? We need to deal with this in this journal entry because some of the interest payment that we're making, of which the total is 15,000, 12,500 was for the last year, and we already took the expense. Okay, so let's at least deal with the principal amount. Okay, so we're gonna have note payable go down by 20,000. And we see that again in our table here, right here. This first payment of 35,000, 20,000 is principal, 15,000 is interest. Okay, so we know that it's gonna pay down. Remember, we had this $100,000 credit balance. Now we're debiting it, note payable 20,000. The balance now outstanding is 80,000. We're gonna have to get rid of this interest payable. Just move this down to one. Okay, and then I still need this minus this. I still need 2,500 more in debit to make it balance. So what is this going to be? Interest expense, exactly. So this is for, remember we took this interest expense was for the 10 months in 2026, and this is for the 2 months in 2027. Okay, so now the interest expense is split up correctly between the two periods. Is everyone good with that? We've seen this now many times, I think. Okay, so now let's move on to the mortgage. So again, this was taken out on December 1st, 2026. So we had cash come in, 400,000, and we had a mortgage payable. At the end of the month, we're going to accrue the interest because the loan is outstanding from December 1st through the end of the year. So that interest expense needs to be in 2026. Everyone agree with that? Okay. So 12/31, 2026. It's going to be actually the same form, interest expense, interest payable. So I'm just going to copy and paste these. The amounts, I'm going to go look up here. It's exactly 1 month, okay? They made the dates easy for you in this problem, and that we took it out on December 1st, and the payment is on January 1st, which is the next day, but we're basically accruing all the way up through December 31st midnight, okay? And so it's the same amount because it's the same principal and interest amount as January 1st, 12:01 a.m. Okay, so it's the same as this. So um, the interest amount is this, the principal amount is this. So the but again, we haven't yet made the payment. We're just gonna take the expense because the um the mortgage payable balance is still 400,000. It doesn't get reduced till we actually make the payment. The interest expense is accruing every day from on December 1st, on December 2nd, December 3rd, December 4th. Every day that interest expense is accruing. So we're only accounting for that. Okay. The payment of principal is only going to happen when we actually make the payment. Because maybe we have interest only loan where we don't pay off any principal. That's possible for loans. So that principal amount is only going to be accrued when we actually make the payment. So, but for interest expense, we can just use this first month worth. Okay. And then on the first payment date, What was that? 5. Okay, yeah. So just add a year. Yes, these should be 25 and 26 instead of 26 and 27. Um, okay, so on the first of, of the next year, let's just say, you're gonna make your first payment. How much is the payment amount total? What's the total payment amount? It tells you it's a fixed amount, 8,000. Okay. So that's how much cash is going to leave my bank account. That's how much the bank is going to get. And again, it's split between principal and interest. So the interest portion is going to be basically this 2,300, 333. Now, what account should I do it? I'm not going to do interest expense. I already took the interest expense here. Interest payable. Mortgage pay. So, okay, so Scott, tell me, how much is mortgage payable? Exactly. And you can get that from your table again by looking at the first payment amount, the principal amount. Okay? So this is the journal entry for that first payment. The second payment on 2/1/2027, but it should be 2026 if we were being accurate. But let's just go with me. It's going to be actually almost the same as this. What is going to change? What account is going to be different here? No. Mohammed, I saw you raise your hand. What is it? What changes? Exactly. This is not going to be interest expense. Why? Because the February 1st payment covers January interest, and it's January 2027. So we want this uh, interest expense to be in 2027. So we're okay with expensing it. Okay. Okay. So now what about the amount of cash? What is this? We don't have to look at the table for this. 8,000. We do have to look at the table to see how it's split between interest and principal. So I can just go up here. I'll look at the second payment. And so you can see here the split is 2,300, 288 interest. And the principal amount is on the second payment, this 5,699. Okay? Everyone good with this? Everyone understand the use of the table in relation to the journal entry? Yes? Okay, so for your homeworks, for the kind of systematic way to do these, if I were you, I'd make the table first, and then the journal entry should follow pretty easily after that. You'll at least have the numbers. Now, thinking about how to accrue what period the interest goes in, you'll have to use your brain a little bit for that. But at least the numbers you'll have pretty much done if you do the schedule first. All right, everyone good with that? Yeah. Okay, so um, again, in this problem, you didn't need to use the PMT function because they told you uh, what the payment is. But let's say they just told you the loan amount, the term. So they didn't tell you the term of this loan, right? That's why, like, it's left ambiguous because they gave you that $8,000. Um, but usually in the real world, you're given the loan amount, you're given the loan term, you're given the interest rate, and then based on that information, those parameters, you want to figure out what payment amount will exactly end in this, right? In this zero balance. Okay. And the PMT function, of course, is going to tell you that. It's going to do the math for you. And so stepping through the functions, the first one is the rate. And again, you want the rate to match the payment frequency. So in this case, it's monthly. So we want the monthly interest. Number of periods you want in terms of the number of, if we're monthly, then the number of months. If it's yearly, then the number of years. In this case, we'll take 30 years times 12 because we want monthly payments. We're using a monthly interest. We want the number of months that we're going to pay. Present value is just the amount that you're borrowing, like the loan amount, the starting principal balance. It has some other parameters, but you don't. Those are optional. You don't need to worry about that. If you want to do further research, they're useful in niche situations. But these are the basic ones. Yeah. Okay. Um, okay. So, any last questions on this mortgage problem? I think we did all of them. Okay. Actually, yeah, we did everything, right? Everything's done. Yes. Okay. And then yeah, I think they ask you for one more mortgage payment. You just instead of the second, we did the first one, we did the second one. You just use these amounts for interest and principal. So that's why this table again is helpful. It will help you do every journal entry for the whole life of the loan. Okay, so let's move on. Okay, so bonds. Uh, just basic background. What is a bond? A bond is a form of borrowing. Okay, it's just it, uh, functionally for a company, it is the same as a bank loan. Okay, they're going to receive money and they're going to pay interest in a fixed schedule on that. Okay, the big difference is that unlike a loan, which can be transferred, it's kind of a pain to do it and it requires a lot of kind of legal work and kind of specialized law and accounting things to happen. A bond is made to be tradable. Okay, so uh, the legal structure, the way that it's kind of like, for example, there is a one legal document for an entire bond issuance that if you have 1,000 different bondholders, there will just be one party assigned to negotiate with the issuer in case something bad happens. So in that way, it's made uh, operationally easier, okay, in the way it's structured to allow for many different people to own this loan, okay? So you can think about it as a loan that's split up between a bunch of people, and those people can trade with one another in case one person wants it now and one person wants to get rid of it, they can exchange easily. So this means that a bond is more liquid than a bank loan. It is possible if you're Wells Fargo and you gave like a 10-year loan to some company, you can find a borrower for that, or sorry, a someone to sell that loan to. It's possible, but it's slower. There's like more kind of operational impediments to do that. Okay, a bond, on the other hand, you can instantly just call up a broker, be like, I want to sell this bond, and you can trade it that day, and it's done. Okay, so this is the main difference with the bond and the loan. Um, there is the primary bond market. This is like basically if I'm some company and I want to borrow money, I will go to a pool of investors and sell this bond to them. Okay. And the other thing about a bond is that they're denominated in kind of set amounts. Okay. So $1,000, for example. So an investor can buy any increment of 1,000. So, there could be 100 investors. And let's say you needed to raise $100 million. One investor might buy, $20 million. One might buy only $1,000 worth. One might buy 50 million. One might buy some odd amount, 22,540,000. Okay, but it's all kind of denominated in like denominations of 1,000. Okay, so that again makes it more conducive to transferability, and just other uh, it's like using paper money, right? You don't have to carry around like exact like pennies for every amount. You just have $100 bill, right? So this makes the transaction easier. The secondary bond market is of those investors that have bought the bond, they can now trade with each other. Okay, in case one wants to buy from another, maybe there's another investor that didn't was not part of the primary bond offering that now wants to invest. They can try to buy the bond from an existing investor. Okay, so in the secondary bond market, the company is no longer involved. They already issued the bond and got their money. This is all between third parties. This is not involving the company at all. Okay, does everyone understand the difference? Yeah, makes sense. Usually, when you buy stock, right? If you go on your brokerage account and buy a share, you're not buying it from the company. You're buying it from some other investor. So you're participating in the secondary equity market, right? When the company first wants to raise money, there is also a primary equity market where they raise money from investors, and then those investors have the shares and they sell it to you. Okay, this is why, like on a lot of IPOs, like there'll be insiders that get stock in the company, and then when it IPOs, the stock price goes way up, and they'll just sell it to those people and make a profit. Okay, you're not the company does not usually benefit. Okay. So who are the main issuers of bonds? Oops, shoot. God, I'm just totally biffing this right now. Man. Okay. Um, so the main issuers of bonds, the bond market is bigger than the stock market. Okay. There's more borrowing in our economy than like equity ownership. Um, at least for large companies. And really it's because governments also borrow. Okay, so that really tips it in the favor of like bonds. Okay, so who are the main issuers? So the federal government. So what are the bonds of the federal government called? What do we call them? They are securities, but we have a name for it. It starts with a T. Treasury bonds. Okay, so treasuries are the bonds issued by our federal government. Okay. Um, State and local governments also issue bonds. So cities, states, um, the New York subway system, they have bonds. As I said, the Contra Costa Community College District, they issue bonds. Um, and these are called municipal bonds. They have some tax advantage. So that kind of lowers the cost of borrowing for um, all these entities because the federal government allows the interest to be tax free. Okay. Um, Corporations, so there's corporate bonds. So like companies borrow money. There's asset-backed securities. So these are like RMBS stands for residential mortgage-backed securities. So your mortgage, when you take out a mortgage from Wells Fargo, um, they'll give you the money at up front, but then they will kind of sell your mortgage to Fannie Mae, Freddie Mac. These are like kind of quasi-governmental institutions, and then they will take your mortgage along with thousands of other mortgages, put them into a little legal structure, and then bonds will get issued against that, so that when you pay your mortgage, it's principal and interest, right? As we saw, that principal and interest trickles up to the bondholder. Okay, they'll get some interest and they'll get some of their bond principal back. Okay, so um, residential mortgages get financed like that. Commercial mortgages get financed like that. Credit card. So your credit card company can also issue bonds. Yeah. They're tax exempt from state tax, I believe, not federal tax. They're federally taxable. Federal, state, and if you live in California and you buy California state bond, you don't have to pay state tax, local tax, nothing. Yeah, yeah. But yeah, like let's say you're in California and you buy a municipal bond issued by Omaha, Nebraska city or something, or the state of Nebraska. You will not pay federal tax on that, but you will pay California state tax on that. But if the bond is issued by the state of California and you're a resident of California and you buy that one, you will pay no federal or state tax. So there's special municipal bond funds for California residents in that they only own California issued municipal bonds because then it's totally tax free. Okay. Okay. So again, this world of bonds is very diverse. Okay. One company may have only one share of stock, right? The common stock for, Berkshire Hathaway, they have two classes, but um, they may have many, many different issuances of bonds because even in the same year, they may issue a 7-year bond and a 3-year bond at the same time. Okay. So the number of different securities or issuances that a company has for bonds is usually many, many, many times more than the number of stock. Because usually companies only have common stock. They just have one class. Okay. But the bonds, again, they're issued over different years, different payment schedules. And so this is a much more niche kind of area of investing because it's much more complicated than investing in stocks. The trading is largely between human traders, okay? Except for like treasury bonds and like certain like large corporate bonds. Um, it's usually done between humans. If you're a bond investor, you'll call a trader. You'll say, "Hey, I want to buy these bonds." They'll give you a price quote, and you'll like execute the trade if it's a good price that you want to buy at. Okay, so um, it's still, and again, it's because it's much more complicated. Okay, you got to know exactly which issuance you're talking about. There's a lot more like there's a lot more to negotiate here than just buying a stock, which is like a kind of commodity thing. Okay, so some terminology. Um, so the bond, as I said, it has a schedule, like we saw. Like there's going to be some principal, and there's going to be an interest rate that the bond pays. The interest rate that the bond is scheduled to pay. So let's say it's a treasury bond that's like, it's let's say it's $1,000 of face value, meaning the the value of the bond is 1,000, and it's a 5% coupon rate. And let's say it makes yearly payments, and at the end they will pay back your principal. Based on that, you know exactly what's going to happen. It's going to pay you $5, $5, $5, $5, and in the sorry, $50, $50, $50, $50. That's 5% of 1,000. In the last year, it'll pay you 1,050. This is a fixed schedule of payments because this coupon rate is kind of it's stated on the bond itself. It's like this is the amount, this is the interest that that this bond is going to pay. Okay. So you'll know as an investor that you're going to receive this series of cash flow. Okay. And it'll have a date on it, and you'll know exactly when you should expect these. Okay. So there's different ways of saying this 5%. The stated rate, the face rate, the coupon rate, the nominal rate. These are all synonymous terms. This $1,000, um, that's kind of the denomination, but maybe they issued $10 billion worth of bonds denominated in thousands. This 10 billion is the face value, the maturity value, the principal amount, the par value. These are all also synonymous terms for the total issuance. This is basically how much the bond issuer is going to pay back. Okay, so these are all you'll see these different terms used, but they're all synonymous. Okay, the problem and the confusion comes in that the coupon rate and the market yield, meaning how much you would receive in like kind of as a return, they're going to differ because interest rates change over time. And I'll show you the math behind this. Okay. So um, bonds are bonds fluctuate in price just like a stock does. Okay. They're not as volatile for various reasons, but they do fluctuate in value because they're outstanding for 10 years. And let's say you're a company, the company's fortunes change during those times. Okay, that's one thing. The base rate of interest, how much you could earn just by investing in, let's say, US Treasuries, that's going to change over time. And that's going to shift all the returns from everything else that's based on that. Okay, so that all varies. So there's a market value for bonds. They're either quoted as a percentage of par. So if you sell 98, that means 98 cents on the dollar. Okay, so you could look at this $10 billion bond. If it's trading at 98 at a price of 98, means the total value of the bond is 9.8 billion. Okay, so this is called a discount because it's trading under the par value. It could also trade over the par value at like if it is 110. Okay, um, these these prices correspond to a yield, and I'll show you how that relates in a second. But it's based on kind of this time value of money formula that I mentioned. Okay. Um, but I think the key thing to remember is that the values fluctuate. Okay. Um, what else do we got to say? Yeah. Okay. So the key thing, market yield, meaning the price of the bond, and the coupon rate are not the same thing. Okay. The coupon rate, again, determines this schedule of payments. The market rate, as we're going to see, is something different. It's related. It's going to be based on this schedule, but it's going to be based on other things. Okay. Um, the payment of interest, it can follow different schedules, semi-annual, quarterly, annual. There are some bonds that are zero coupon, meaning that they only pay out the par value at the end. So how would an investor ever make money on that? If let's say it's a 5 year zero coupon bond, the cash flow is this 0, 0, 0, 0, 100. So what if you're an investor, how much are you going to pay for this? This is year one, year two, year three, year four, and year five. And right now you're here. You're at year zero. Okay. So how much would you pay for this? Would you pay 100 for this? What would that mean if you paid 100? Would you earn anything? No, you wouldn't earn anything. So what are you going to pay? Can we agree less than zero? Or sorry, less than 100? Yes. So this is an illustration of why bonds can trade at a discount. Okay. Because if you just paid par, meaning a price of 100, you're not going to earn anything because this is a zero coupon bond. Okay. So, I don't know what's up with this pen. Okay. Anyways, let's just try to continue on here. Um, So the key things that we got to keep in mind for a bond issuance is the issue date, maturity date, coupon, the payment frequency, and then the price. Okay. So if we look at, so this is a bond that the uh, Contra Costa Community College District has issued. And it's good. We have a little summary here from our friend Gemini, but let's just go through it. We don't really need that. Okay. So look, they issued uh, $110 million of general obligation bonds. And then there's a different class of bonds that they're issuing together for 35 million. Okay. Um, what is some other details here? So you can see here that the payment schedule. So this is the maturity schedule. This is how all this $110 million is going to get paid back. So there's one that just has one payment date. This is just one class of the bond, but this is another one. Okay. So the the interest rate is 4%. This is kind of the coupon. And you can see that the yield is 0.24. Okay, so though this thing is paying a 4% coupon, the yield is much lower. Why? Because at this time when they issued in 2020, interest rates were like zeroed out. So in order for this thing, which pays 4% coupon, to yield so low, you can see the price of it is over 100, meaning that though the investor is only going to get 5.7 million on this payment date, they're upfront paying whatever, almost 6 million, over 6 million. Okay. So they're going to pay $6 million up front and they're going to receive this 4% coupon, but they're only going to get $5.7 million back on the back end. So that extra amount that they're paying up front, they're kind of losing, but they're getting a 4% coupon. So the net of that is a very low yield. Okay, so that's why uh, bonds can trade at a premium, because though you're paying more than you're going to receive, the coupon is high, and there's some offsetting effect of that. Okay, so this would happen when interest rates are low. You can see that all these are priced at a premium. Okay, because this 4% coupon when interest rates are at 0% is quite appealing, and so investors are willing to pay more than they're going to get back in principal, because the coupon of 4% is so attractive. Okay, and you can see the net result of that is given in this yield function, or this yield column. Okay, so that's why all these pricings are, again, over 100. They're paying more than the principal payment. Okay, but there's a reason. There's a technical reason why that would happen. You can see here that in these issuances, the coupon is lower. It's only 2%. The pricing of the bond is under 100, and that's why this yield is over the coupon, because basically now, instead of paying more than 9.885 million, you're paying 9.7 million. So on the back end, you're getting this 2% coupon plus a little extra, because you didn't pay the full principal when you invested in the bond. That's why you're getting a little more than 2.2. You're getting more than the coupon rate of interest. Yeah. Yeah, it's gonna be based on the current market. The coupon is arbitrary. As I showed you, you can have bonds that are zero coupon. It will still price in the market, right? There'll still be some price investors will pay. It'll just be under the par value, right? Um, okay, so this is a little technical. This is what I'm saying. This is a little complicated. Um, this is the payment schedule. Okay, so you can see that what we saw before is kind of a summary. This is every payment that this bond series is paying. You can see that there's some that are principal payments. There's some payments that are interest only, like these interest only payments are happening in 21, 22, 23. Then there's another principal payment. And you can see here, if you add up all these, this is one of the series. The total principal payments adds up to 110 million. In the other series, these refunding bonds, the total principal payment adds up to that 35 million. The interest, this is based on that 4% coupon. This is what they're going to pay. Okay, so this schedule is based on the coupon rate, the stated rate. Now, investors, the total value of this is 150 million. Maybe investors only paid, or in this case, it looks like they paid 170 million. Okay, because the interest rates were low. So the proceeds to the community college were maybe 170 million, and they're paying out 150 million total. So of which 110 is principal, and whatever the remainder is interest. Okay, so the extra amount is kind of lowering the interest cost. Okay, so we'll see this again. This is a little complicated. I think when you do the math of how this works out, it'll become a little clearer. But again, I think what I'm trying to emphasize here is that the coupon rate of interest is not a market-based thing. This $40 million is kind of arbitrary. Okay, the market, depending on what the interest rate environment is, will price this bond accordingly. They'll take this total amount, and like investors will want to get some. Actually, sorry, it will always be under 150 million. Okay, because if an investor paid more than that, they're not going to. They're giving more money away than they're getting. Okay, they're gonna not necessarily pay 110 million. That's the principal amount. That will vary. It could be 120 million. It could be 98 million. That's going to depend on the interest rate environment. Okay, um, but total, the investor will get this 150 million. That's interest from the coupon plus principal. Okay, um, I think we'll have to. I'll revisit this because this is complicated. I'll show you some bond pricing, some trades that happen, and then we'll do some of the calculations. Okay. All right. Sorry. Yeah, this is dense. I realize this, but that's what I'm saying. This chapter is pretty hard.